All right, ladies and gentlemen, I hope you had a wonderful weekend. We got a major week ahead of us filled with every giant catalyst you could think of. We got Jerome Powell in the summary of economic projections on Wednesday, PPI on Thursday, Michigan consumer sentiment on Friday, and a lot of people have overlooked. We also get the CPI the morning of Powell. So not only do we have all of that, we are coming off of a week where we saw two major central banks cut last week. You had a lot of craziness with meme stocks and oil and gold. And now, believe it or not, it's kind of like I say this with honor and pain, believe it or not, currently now the yield curve is the most inverted it has been since 1920. So we have a little bit of a discussion there. I got some cool pictures, all of that. I also have the plays, the keys, everything you need. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/The Stock Market. We will see you there in the morning. And don't forget, today is Sunday. Tomorrow is Monday. We have the random account generator. I'm trying to log in while I'm telling you this, but if you don't know, we have a YouTube account that we created for random option plays. And what we ask on this watch list, you post a random option in the comments. Keep it below $100. Post the strike price, expiration date, all that good stuff. And I think, is this it? I'm trying to show you. And then we're going to buy it in the morning and see. So there it is. It's not bad. We had a killer start to the year, and then right when I told you guys you were doing good, we stopped. So yeah, we need a play, baby. Let's go. Run it.
Working to the couch, it's the 2020 election. Live in the hills, but still get a spread. Started with a live, but it's still reinvested. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
But right off the bat, like I told you, this week is going to be filled with major catalysts, and do not underestimate the SEP. So SEP, that stands for Summary of Economic Projections. This comes out every 3 months at the FOMC meeting. They include a summary of what they expect to happen at the end of this year, next year, and then the year after that. Everything from PCE and GDP estimates to ultimately where all of the Fed members think that the rates will end up being. This is where we get the dot plot and that median terminal rate. So this is going to be absolutely huge, and it's not just for this week. This could define the week, the month, and literally the whole entire summer, because we will not be getting another SEP until November or September. I'm tripping, but the whole idea here is whatever Powell says, especially as it coincides with the data, that will give us our runway until we get into the next SEP. And now what I'm saying here, the question is going to be, does Powell stay the same just like he and the Fed has been? If you don't remember the last SEP, we could have got excited about it, and we were. I know I was. And then nothing changed at all. So does that happen again? Or now that you have seen Bank of Canada, the ECB, and we might get a couple more, is Powell going to slowly start adjusting to some of those other people around the world and kind of hint at what the plan is moving forward? So I'll give you a deep dive on this once we get closer, but the SEP on Wednesday, this will probably be the biggest news of the month in the summer until we run into anything else, and only if Powell ends up changing. So that is key number one. Then coming into key number two, it's not just about Powell and the Fed. We have the CPI on Wednesday, and then you're even going to get the PPI on Thursday, and then Friday you got the consumer sentiment. But the tricky part about the data this week, if you even remember on Friday, I was telling you, I'm not really even expecting much out of the non-farms just because we have Powell right around the corner, and the market has been falling into this idea that it's had recently, so it doesn't really matter. But this is where it gets tricky, because after Powell speaks, that's going to either confirm or deny a lot of what's happened in the data, and confirm or deny should you be worried about it. So the data will definitely mean more after Powell talks. Like I said, not only do you get the CPI, but PPI, that has the ability to move the bonds, consumer sentiment, and then as we get into next week, all these little data sets, once we know the frame or the perspective Powell is looking at in the Fed, that will give you a lot more. But it's not as if we are just waiting for Powell this week. There's a couple of these moving pieces, so don't forget about the data. But that is key number two. And then finally, My favorite topic, man. And if you haven't seen any of the old videos, you should. We have them on this channel. Literally, I have been talking about the yield curve for almost a decade now, and it's kind of mind-boggling, but this has always fascinated me, and the yield curve fascinates a lot of Wall Street as well, because 9 of the last 10 recessions throughout 1920, they all were preceded by this inverted yield curve that we are in now. So I brought up a fun fact to you at the beginning of this year. We are now 6 months in, and now literally the yield curve is the most inverted since 1920. So I have this chart right here, and you could see it doesn't go back to 1920, but even then, the other ones, never do we go below this line and really stay there. So you'll notice we hit it once, came back up, but then this period of spending pretty much almost 2 years, the last time that ever occurred was the Great Depression in 1920. So not only do we have that going on, I'm not only talking about the yield curve here, we'll talk about it in a little bit more, but what I really want you to understand is that now the yield curve is hitting this point. You are now starting to watch central banks around the world start to cut, and what you are about to experience for the next 6 months, I firmly believe this, because this is what I've been saying since January. It's all about the who, what, why, when, if, how, all of that related to the policy shift. And if you're not getting it now, look how bonds have moved. Look how oil is even moving. Look at the dollar, gold, all of these things. We are trying to decide whether or not we get a soft landing or hard landing. From the beginning of the year till now, everybody has been saying soft landing or no landing. Now we're getting into the final stretch with Powell. You got the yield curve. We're even going to get the election. And realistically, these next 6 months, it is going to be whether that soft landing, no landing odds stay in place, or if we move back into hard landing. A lot of people in Wall Street are talking about this. That little bond rally we saw last week, that would be part of it. If we switch to hard landing mode and everybody starts expecting hard landing, you're going to watch the bonds and value and certain things related to that start to catch a bid. If the data starts to prove that, if Powell starts to kind of guide us towards, oh no, hard landing, we're finding falling behind the curve, there's going to be a lot of changes. But if not, and we do what we've done the last 6 months, the data comes out, everybody doesn't get worried, nothing else breaks from there, and then we're like, no, like, look at, we're getting close to it. We are going to have that soft landing. All of the other soft landing trades are going to keep going up, and everything that's been bearish in that moment will keep going down. But this should define the next 6 months here, whether or not hard landing odds come back into play. And if they do, it brings about a whole set of plays and positioning. And if it doesn't, then we just ride this to the promised land. But keep that in mind. The final thing I'm going to show you, just more yield curve stuff. I saw these over the weekend, and I thought I would share them with you because it's highlighting, the history of the yield curve inversions, not only how long we've been in one, but even now to this day, everyone's like, well, nothing's going to happen then because nothing's happened. It's been inverted. But man, just look through the history here. And like it's saying, the current longest of 3 month versus 10s and 2 year, 10 years data back then. So we'll see how that one goes. But the point is, we are living now through a very interesting spot in that yield curve. It has not made the big move. And ironically enough, that big move with the yield curve is tied to Jerome Powell and whatever happens with the policy. So Chad, I hope you're ready for all of it. But now, let us get into the plays. So, right off the bat, I have a couple of plays, and the first one comes with a pretty picture as well here too. But oil, I brought this up last week. I like the price. We got out of it with the gain. It kept going up, but I might be going back into this, and this is starting to get very compelling. This is from Bank of America, I believe Michael Hartnett, and what he was talking about, oil is a upside hedge for the pre-election global tensions, and currently right now, there is literally no risk premium priced into oil. This is actually mind-blowing, and what this is showing you is oil versus gold, the oil versus gold ratio. And usually when gold starts taking off, you see other commodities, especially oil, fear, all of that, even geopolitical tensions cause gold to spike. Usually it brings up oil, but if you're looking at that ratio now, oil is at one of the lowest prices compared to gold, even if you compare it with copper and other things. And what it's saying is that there is more risk priced in to all the other commodities than oil right now. So the general idea is, yeah, it could go a little bit lower, but it should hold on. And if something bad does happen ahead of the election, this is the cheapest play right now that should benefit off of it. And even if nothing does happen, I mean, you're just back to holding oil, not at the 90s, but definitely not at the lows of 40 or negative, and then kind of like in a higher middle. So I thought this was very interesting. I'm definitely going to be keeping my eyes out for this. We played it all last week, so now with this in mind, especially after the SEP and all of that, I definitely think this is one you should be keeping your eyes on. So that is play number one. Play number two, baby. GME. This thing was insane on Friday. It's been a lot of craziness, and it's not over yet. I think Roaring Kitty has a plan. He did his live stream. 600,000 people were there. A lot of people were disappointed. I was surprised, honestly. If anything, my thing, because I made a play, and I took a loss on it, and that's why I'm saying even here, play for the momentum, not the jihad. Don't get so, like, into it where you're, I have to. It's like, no, just like, bro, if this thing's moving 30, 40, 50% in a day, there's something garnering that many eyeballs. I mean, hey, if you got the right timing, right positioning, there is going to be stuff for short term. Is that gambling? Yes, it is. So I don't know any other way to put it for you, but the general idea here is play the momentum. And even for me, I was reminded of this game. There's a lot of trolling, a lot of back and forth. It was a different set of momentum, but like I'm saying here, I just don't think this is over from Friday. There's too much going on. Kitty is showing his positions. His options expire in a couple weeks. They keep halting it. You have E-Trade saying they're going to ban him. You got people covering their shorts and then people opening. It's just like all of this stuff is probably going to keep going on. So I'd watch out for it. I have no more plays in this now. I even sold out of my old 4 shares from before, but I definitely think this will come up here, or at the very least, whenever we start getting past the data and there's kind of like some dead space waiting for the next catalyst, I'm sure this thing is probably going to take over some headlines. But it was a huge week last week on Friday, so keep your eyes out. Let's see if that one continues. And then finally, JP Morgan and Netflix, baby. I cannot stress this enough. After we get this Fed, the SEP, the data, and all of that, before you know it, earnings is going to be right around the corner. So these are the first ones that usually come out. I mean, there is other names, but these are the big dogs. There's a lot riding on it. I think even Netflix climbing back towards all-time highs. Banks were very weird last week too. So as we start moving past these catalysts, just prepare yourself for earnings by either looking at the prices, what's priced in. You can make your play. Definitely be careful on the early options, because if you do go early, sometimes it's the best thing in the world, or you'll play 2 standard deviations like 3 weeks early, and by the time you get to the earnings report, it'll be like 18 standard deviations outside the money. So that's why we usually price the day before. But what I'm saying here, we got big macro to hold on to. We're riding the wave and seeing all of this stuff, but one of the age-old, practices of the market, earnings, we love it. It's going to be there right around the corner, and just don't forget that gets stocks both stopped and moving as we wait for the releases. So watch out for that. Those are the main plays. As far as what I did on Friday, it was a wild, wild day. So I got into GME. I actually closed out of AIM. That was the bird food play. I got a small gain out of it, but I said, hey, if I had 20,000 shares of that, and then I'm going to go start gambling on the momentum or GME, I didn't want to leave too much for the market maker to take. So got out of AIM with the small profit. They kind of screwed me with the order and the sizing and how illiquid it is. And then I played GME. I got in at $35, I think, $35.50, and then it shot up for a little. I was up 1,000, and then the stream came on, and then it went lower. I closed at 28, so I took a $3,000 loss on the shares. I bought 500 of them, but I did a covered call. I went to the January 26 plays, and I sold a covered call at 125, collected $5,000. Ended up making 1,000 and some change off of that, even though it expires in 2 years and all of that. So that helped out, but no more GME. That was the first one. And then, bro, I'm pissed. I got to go yell at E-Trade. They scammed me. I did a daily play. I did a daily credit spread, and they were going for a lot of money. It was because crowd got added to the S&P. The contracts expired out of the money, and then they assigned me the next morning, but then they let my shares expire. So now I'm short 100 shares at 165, but I got scammed on that. We'll talk about that one as we get into it live. You'll probably see me deal with it, but that was just a premium sell. We thought we had something, and we should have got it, but Damn market makers, E-Trade. I'm looking at you. And then still holding my 1,000 shares of MO. Watch out for the ex-dividend coming up. I still have the RTY and M2K. This one didn't go down as much. This one got smoked like $1,000 after Friday, but I still think with all the data, I'm down to ride this one out a little bit. And then still in my short MNQ, it was up barely. I actually was negative most of the day on Friday, even though we were down, and then it started to come down a little bit. So still in all of those plays. Other than that, probably going to take everything slow this week and then move really, really fast once we get the SCP. But now I don't have any questions for you guys today. I actually missed asking y'all. I've already exhausted my whole document, but for the essence of time as well, I'm going to get straight into the lesson, and we are going to move on to chapter number 5. Can you guys believe that? I'm telling you, man, I don't care if you like me or not, whatever it is. It's like, bro, look at what you could do every single day, 30 minutes, 40 minutes a day. We are about to finish one. Not finish, but we've made a lot of progress, man, and I really hope that motivates you in all other areas of your life. And if you haven't checked out the playlist, we have the whole entire playlist of all of these economic lessons. It's on this channel, but it's like, I'd love that you guys are learning this, and I really hope it's giving you a more stronger foundation for the markets and maybe even inspiring you and interest you in everything that's going on around the world. So enough of my ranting, and remember, if I am reading from a book and then I stop to give you an opinion, that is opinion. That's all biased, and that's it. So that's why I've been trying to show you some stuff where it's giving you both sides, but be mindful of my contribution, as I don't want it to distort what you are actually learning. But that being said, what we're going to be talking about today is the state-centered approach to trade politics. We are going to have the conclusion of the society-centered approach to trade politics, but this is what I want you guys to understand, and like a big thing, because we're spending time breaking it down, and we're going to do this a couple more times as we get through the book. But what you have to realize is that there is a difference between society and state actors. Like, and more or less, you know, it's like blaming the government for everything, or it's like saying, no, like, we have our local communities. It's like, maybe that's a bad example, but what I'm trying to tell you is, like, there's a different school of thought that comes into play when you're trying to look at, like, the effects of society and what people do in, like, societal ways. Again, like, some of the difficulty we've been going through in the modern time with some of these theories is that nowadays, like, people don't even care about factor models and all of these things. They don't care as much about their interests as they might care about society and everybody as a whole, versus state actors are just like government institutions. If you believe that they don't literally care about society at all, just state-based, like China, that's probably the best example. So I want you guys to understand that, because some of these may sound similar and we're going through it all, but it's kind of understanding both the government, how they operate, their influence, and then people, and then at people, whether they align with business, economies, interest groups, or if they stick to other broader things based on the broader good. So hopefully that helps. But now let us get into it. I need to actually find the conclusion. We're starting with the conclusion. Although a society-centered approach helps us understand how the interaction between societal interest and political institutions shapes trade politics, it does have weaknesses. We conclude our discussion of this approach by looking at the 3 most significant weaknesses. First, a society-centered approach does not explain trade policy outcomes. It tells us what trade politics will be characterized by conflict between winners and losers from international trade, and it does a fine job of telling us who the winners and losers will be. It does not help us explain which of these groups will win the political battle. Presumably, a country's trade policy will embody the preferences of society's most powerful interests. To explain trade policy outcomes, therefore, we need to be able to evaluate the relative power of the competing groups. The society-centered approach provides us little guidance about how to measure the balance of power. The temptation is to look at trade policy outcomes and deduce that the most powerful groups are those whose preferences are reflected in this policy. Yet, looking at the outcomes rendered that this approach tautological, we assume that the preferences of powerful groups are embodied in trade policy and then infer the power of individual groups from the content of trade policy. Thus, the society-centered approach is better at explaining why trade politics are characterized by competition between organized interests than telling us why one group outperforms another in this competition for influence. So, like it's saying here, although we've explained a lot, and like I don't know if you're thinking about this, but we had that example, and remember it was talking about the collective action problem and getting everybody associated, and it was talking about the problems of aligning interests. But when we were talking, we were trying to deduce who was powerful or not and how that affects things. But he is saying that that's not what this model tells us. It could just tell us kind of why people believe a certain thing and how it's shaped by winners and losers in politics. So continuing, second, the society-centered approach implicitly assumes that politicians have no independent trade policy objectives and play no autonomous role in trade politics. This assumption is probably misleading. Politicians are not simply passive recorders of interest group pressures. As Inkenberry, Lake, and Mastaduno note, politicians and political institutions can play a critical role in shaping the manner and the extent to which social forces can exert influence on trade policy. Politicians do have independent trade policy objectives, and the constellation of interest groups that politicians confront is not fixed. Indeed, politicians can actively attempt to shape the configuration of interest group pressures that they face. They can, for example, mobilize latent interest groups with preference for liberalization or protection by helping them overcome their collective action problem. By doing so, politicians can create coalitions of interest groups that support their own trade policy objectives. Political institutions also affect the extent to which social groups can influence policy. In some countries, political institutions insulate politicians from any interest group pressures, thereby allowing politicians to pursue their trade policy objectives independent of interest group demands. We will examine this in greater detail as we look for the state-centered approach in the next chapter. So this is good because we're going to talk about this, but this whole chapter 4, one of the assumptions is that, again, and remember we were talking about how people are there to people in government represent the interest groups, the workers, all of that. But it's saying like, dude, these guys aren't just passive. They can have a bigger role and they could be involved with creating the coalitions and all of that. So you got to kind of think about, and that's why the next chapter, and we're going to be getting into the state center approach, and we have talked about elections and all of that. That's where some of those other factors come into play and are different than, the same factors that you would align with or your interest group if you have an election to win. So continuing, finally, the society-centered approach does not address the motivations of non-economic actors in trade politics. Societal interest groups other than firms, businesses, associations, and labor unions do attempt to influence trade policy. In the United States, for example, environmental groups have played a prominent role in trade politics, shaping the specific content of NAFTA and attempting to shape the negotiating agenda of the Doha round. Human rights groups have become active participants in American trade politics. This has been particularly important in America's relationship with China. Human rights groups have consistently sought to deny Chinese producers across the U.S. market in order to encourage the Chinese government to show greater respect for human rights. The assumption that trade politics are driven by the reactions of interest groups to the impact of international trade on their incomes provides little insight into the motivations of non-economic groups. The society-centered approach tells us nothing about why groups that focus on the environment or on human rights spend resources attempting to influence trade policy, nor does it provide any basis with which to make sense of such groups' trade policy preferences. In the past, such a weakness could perhaps be neglected because non-economic groups played only a small role in trade politics. The contemporary backlash against globalization suggests, however, that these groups must increasingly be incorporated into society-centered models of trade politics. So, hopefully you get that, because this is kind of a major failure of the whole approach that we've gone over, because it doesn't really tell you how to think or how to characterize somebody if you are removing trade interest and monetary value. Like literally, that's what it's saying. It's like, how do you model then with everything we learned in this chapter? How do you take a human rights group trying to advocate to stop the trade in China? It's like, wait, why? Like, why are they doing that? Yeah, they're interested in it, but like, it's really hard to answer the why if you are using this model. So it's a pretty big glaring weakness, and I'm sure even then this could even be a question for some of y'all, especially the most skeptical of y'all, because like you got to really think about it. It's like saying, well, is it that some of these groups, some of them, they don't really have an economic motive, but I know a lot of us in the lobbying and everything, maybe that's how we define it, but even then, you're going to have to go through a lot of things. But like it's saying here, eventually these economic models will start having to account for that given how people have been behaving. So Finally, although recognizing the weaknesses of the society-centered approach is important, these weaknesses are not reasons to reject the approach. The appropriate measure of any theory or approach is not whether it incorporates everything that matters, nor even whether it explains every outcome that we observe. All theories abstract from reality in order to focus more sharply on a number of key aspects. Consequently, the appropriate measure of any theory or approach is whether it is useful. That is, does it provide us with a deeper understanding of the enduring features of the phenomena of interest? On this measure, the society-centered approach scores high. By focusing on how trade shapes the fortunes of different groups in society, it forces us to recognize that the enduring features of trade politics revolves around a continual struggle for the income between winners and losers from international trade. Wow. So that's the conclusion of the last chapter, society-centered, and now let us begin the state-centered approach. So I only got a little bit, and then we're going to work more into it throughout this week. So not too much. I just wanted to make sure we could close out the last chapter and then start this one up pretty easily. So a state-centered approach to trade politics. In the fall of 2017, the United States Department of Commerce announced the intention to impose tariffs of 300% on the Canadian company Bombardier's new C-Series commercial aircraft. The American move came on the heels of a decision by Delta in 2016 to purchase 135 of the new jets. Boeing responded to Delta's purchase decision by filing a complaint with the U.S. Department of Commerce and the U.S. International Trade Commission, alleging that the Bombardier has effectively dumped the C-Series into the American market, selling them for less than two-thirds the cost of production. Moreover, Boeing alleged that the Bombardier could afford to offer such steep discounts because the Canadian government had subsidized the airliner's development. In total, Bombardier received little more than $1.6 billion in various forms from the Canadian government, a significant share of the estimated $6 billion the Bombardier spent to develop the jet. The steep tariff was thus intended to offset the subsidy of the Canadian government. The Canadian government, as well as the British government, which hosts some of Bombardier's production, has threatened to retaliate by not purchasing Boeing-made fighter jets. The tariffs were never imposed, however, as in a somewhat surprising move, the U.S. International Trade Commission ruled against Boeing in January of 2018. How do we make sense of trade conflict? A society-centered approach suggests that we should look at the political influence of the industries concerned, and indeed, there is little doubt that Boeing has substantial influence in American politics. In 2004, the then President George W. Bush acknowledged this influence when he promised Boeing workers that he would end EU subsidies to Airbus. Such influence persists today. In the first year of the Trump administration, Boeing management began direct conversations with the president, yet the Boeing-Bombardier conflict also raises issues that are not readily incorporated into the society-centered approach. In particular, this isn't an instance of conflict between an American import-competing industry and a foreign export-oriented industry. Instead, the conflict is between two export-oriented firms battling over global market share. Moreover, the conflict does not revolve around one government's use of tariffs to protect domestic producers from foreign competition, but instead focuses on retaliation for one state's use of government subsidies to support the domestic firm as it competes for global market share. To fully understand the trade conflict in the commercial aircraft industry, therefore, we must broaden our understanding of economics and perhaps also the politics of international trade. We gain this broader understanding in this chapter by developing a state-centered approach to trade politics. A state-centered approach argues that national policymakers intervene in the economy in pursuit of objectives that are determined independently from domestic interest groups' narrow self-interest concerns. Moreover, this approach suggests that such intervention may, but not need necessarily, raise aggregate social welfare. We examine the state-centered approach with a specific focus on government intervention designed to promote the development of specific national industries. We look first at the broader economic justification for protectionism aimed at creating internationally competitive industries, then narrow our focus to the use of such measures by the advanced industrialized countries in the high-tech industries, and then apply the logic of this approach to the current U.S.-EU conflict in the commercial aircraft industry. We conclude this chapter by looking briefly at some of the weaknesses of this approach. So, I hope you guys are ready. That should give you a little bit of the ending. And now we're going to talk Boeing and all of the other stuff. But like it's saying here, this one, it's ignoring interests, and it's pretty much saying the state-centered approach. State comes in regardless. Think Jerome Powell when he had to do emergency cuts. If the government has this thing and the government's like, oh, we need to do stimulus, at some point they are going to ignore all of the other interest groups. So we'll see how this plays out, Chad Adonia. I hope you're ready to learn a lot more. But Chad, that is all I have for you. That is your watch list, ladies and gentlemen. Make sure Hydra Healthy ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. I need you to remember, you got to expect some good things to start happening. Oh, yeah. You got to watch the expectations in the market, but I'm saying broadly in life. Start expecting it, baby. So, Chad, I will see you in the morning. Drink that water. Stay hydrated, healthy, all that good stuff, and horn.